Have you ever wondered how to create an investment portfolio? Well, an investment portfolio is like a financial toolkit, tailored to help you reach your financial goals. It's a collection of various investments such as stocks, bonds, real estate, and more that you own. The magic lies in how you mix and match these tools based on your financial objectives and risk tolerance to create a diversified portfolio that can weather market ups and downs. Let's dive into the steps to build your own portfolio. The first step in creating an investment portfolio is setting clear financial goals. This means defining your objectives, which could include saving for retirement, buying a house, or funding an education. Your goals will be the compass that guides your investment strategy, helping you determine which assets to invest in and how much risk to take. Remember, every investor's journey is unique, and your goals should reflect your personal financial aspirations. Once you have your goals in place, it's time to assess your risk tolerance. Now that you have your goals, how much risk can you tolerate? Risk tolerance is a critical aspect of investing, and it refers to your ability to weather potential losses. Are you someone who can sleep soundly even when the markets fluctuate? Or does the mere thought of a downturn make you anxious? It's crucial to gauge how comfortable you are with volatility, as this will influence your investment decisions. With a clear understanding of your risk tolerance, you can start diversifying your investments. Diversification is key to managing risk in your portfolio. Picture it like a buffet. Instead of filling your plate with just one item, you'd likely mix things up to enjoy a variety of flavors. Similarly, diversification is about spreading your investments across different asset classes like stocks, bonds, real estate, and more. This way, if one asset class performs poorly, the others could potentially buffer the impact on your overall portfolio. Now let's talk about asset allocation. This is essentially deciding how much of your portfolio you want to dedicate to each asset class. Your allocation might look different based on your age, financial goals, and risk tolerance. A younger investor might lean towards stocks for potential growth, while someone closer to retirement may favor income-generating assets like bonds. Let's illustrate this with an example. You might allocate 60% of your portfolio to stocks, 30% to bonds, and the remaining 10% to alternative investments like real estate or precious metals. This is just an example, and your allocation will depend on your unique circumstances. Now that your assets are allocated, it's time to select your investments. Choosing the right investments is critical to your portfolio's performance. When diving into the world of stocks, pay attention to company fundamentals. This involves analyzing factors like earnings growth, balance sheet health, and industry position. For bonds, consider credit ratings and interest rate trends. High credit ratings typically indicate lower risk, while interest rates can impact a bond's price. Remember, the key to successful investing often lies in thorough research and informed decision-making. Once you've made your investments, it's crucial to review and rebalance your portfolio regularly. Maintaining your portfolio requires regular review and rebalancing. It's not a set-and-forget process. Keep an eye on your investments to ensure they're performing as expected and still align with your financial goals. If an asset class overperforms, it may become a larger portion of your portfolio than desired. In such cases, rebalance by selling some of it and buying more of the underperforming assets. This brings your portfolio back in line with your chosen asset allocation. With these steps, you're on your way to creating a robust investment portfolio. Remember, creating an investment portfolio is a journey, not a destination. It's about setting clear goals, assessing risk tolerance, diversifying, researching, and regular rebalancing. Don't forget the importance of an emergency fund, staying informed, and considering professional advice. It's a process that requires patience and resilience, but the rewards can truly be worthwhile. So keep learning, keep growing, and remember, the best investment you can make is in yourself. If you found this video helpful, please like, share, and subscribe for more financial advice. Happy investing.